Hello, folks. Thanks for tuning in to TD Talks. I'm your host, Fiduciary Investment Advisor Taylor Davis. And today, TD Talks a little bit of everything. There's so much going on all over the world that there's no one topic I can really focus on. I got a lot on my mind today, and I have time to record this podcast, this market commentary podcast for y'all. There's so much on my mind, I'm just going to bounce around. There's no one topic that I could cover and neglect others because I think they're all equally interesting and important and frankly relevant. So let's get into it. As of around noon Eastern, today, Thursday, March 12th, 2026, the big story on the market is not just Iran in a general sense. Isn't it crazy that a war, a full-blown war, multiple countries involved, is not the biggest story? It's just a piece of the big stories. Right now, we're sitting in the collision of geopolitics, energy, inflation expectations, and sector leadership. Right now, the focal point is the Strait of Hormuz. That is one of the most important energy choke points in the world, one of the most important energy choke points in the world. When that passage is threatened or disrupted, as it is now, the market immediately starts repricing oil, shipping risk, inflation risk, ultimately economic risk across the board. I mean, I think only 25% of the oil pumped out of the ground goes towards like fuel. The other 75 goes towards manufacturing, the making of things. This phone, the tires on every car ever made, refrigerators, microwaves, clothes. It's a lot. It affects everything. And today, those fears are not theoretical. It's happening now. Reuters reported that oil surged as Iran insisted the closure of the Strait of Hormuz would continue, with Brent crude around $100.03 per barrel at the time that I'm going over this, and West Texas Intermediate around 95.25 in that midday reporting window. Reuters also reported attacks on fuel tankers, and broader disruption across regional energy infrastructure, which is why markets are reacting with urgency rather than shrugging this off as just another headline. And that matters because oil is never just about oil. Oil becomes a tax on everything. It hits transportation, it hits manufacturing, it hits consumer sentiment, it hits margins, it hits inflation expectations. So, when the market sees crude jump like this, it starts asking a much bigger question. Does this delay rate relief? Does this delay rate relief, pressure consumers, complicate the whole soft landing narrative? That is where the Iran story stops being a foreign policy story and starts becoming a portfolio story. Now, here is where I think it gets interesting. Even with all that pressure, I still think the market is searching for a path back into tech, especially the higher quality names tied to AI infrastructure, cloud, enterprise software. Not because geopolitical risk does not, matter to that sector. It does, but because once the market goes even a whiff, gets even a simple whiff that AI spending is turning into real revenue, real profit, real contracts, real operating leverage, money tends to rotate back toward the companies with the strongest earnings power and the clearest growth runway and the best guidance, the most optimistic guidance going into the future. And that's why Oracle matters so much right now. Oracle's rebound after the quarterly results was not just a nice bounce in one stock. Reuters reported that Oracle shares surged around 12% on Wednesday when the markets opened after the company raised its fiscal 2027 revenue forecast, easing concerns that its enormous AI infrastructure spending was getting too aggressive. And Oracle also said it still expects $67 billion in fiscal 2026 revenue, and it raised its fiscal 2027 target to $90 billion. That is the market seeing evidence that all this AI capex or capital expenditure It might not just be hype. It might actually be converting into demand. I mean, I was watching the after hours trading after the earnings results came out. I mean, it, jumped. I think it jumped 9 or 10% in like 10 minutes after the market had closed in that after hours trading. So that signal matters far beyond Oracle, because the whole tech debate lately has been this: are these companies overspending on AI, or are they building the next toll roads of the digital economy? And Oracle's print suggested that, at least for some players, customers are showing up, workloads are growing, and the monetization curve may be starting to justify the spending. Reuters also reported that investors have been looking for proof. They've been looking for proof. I'm one of them. A lot of people looking for proof that AI investments are paying off. And Oracle's guidance helped calm some of those fears. I really liked the results that they came out with, and I really liked their guidance. Guidance is becoming more and more important. It's what more and more investors are looking towards. I think it's a piece of the puzzle, but I really liked their guidance. So what does that signal to me? Well, it signals that the market may be setting up for a selective rotation back into tech. I emphasize selective, very selective. Not every company with AI in a press release deserves a premium multiple. And there's a lot of companies out there just throw it in there. And I look it up and I'm like, they don't really do anything with AI. They just say they're using it. Okay, well, I can use ChatGPT, but I don't go around saying we're an AI financial firm. But the names that can show actual enterprise demand, actual infrastructure utilization, and actual forward revenue visibility are in a different category. And that, to me, is the key distinction. In an inflation scare driven by oil, the market usually gets more discriminating. It does not want fantasy. It wants durability. It wants something solid. It wants the all-wheel drive truck. It wants cash flow. It wants pricing power. It wants backlog. It wants guidance that management can defend. Oracle's rebound says investors are willing to reward companies that can prove on paper, prove it, not just sell it, but prove it, that AI is moving from concept to commercial return. So here's the push and pull that I'm seeing in the market right now. On one side, you have Iran, the Strait of Hormuz, shipping disruption, oil over $100 a barrel in Brent, and the fear that a renewed energy shock, can bleed into inflation and make central banks more cautious. Goldman Sachs raised its fourth quarter 2026 crude forecast because it now expects a longer disruption in Hormuz flows, which tells you this is not being treated as a one-day panic. On the other side, you have a market that still wants to own growth, especially if growth is backed by AI revenue instead of AI promises. That is why I think the next rotation, if it builds, is not necessarily a broad-based melt up in every tech name. It's more likely a rotation into the companies that can say, we spent the money and now here's the return. We spent this money and you doubted us, and now here's the return. Let me tell you who wins if that happens. Again, if that happens, are the people who are long-term investors, long-term players who've held through this period, who've held through this rotation out of tech, especially people who've bought during this rotation out of tech. Those are people who win in the long run, the people who held and the people who bought. If you're trying to join the party once the rotation comes back in, I still think you'll probably do pretty well over a long-term horizon. But the biggest winners will be the people who held and maybe bought a little bit during that period. That is why Oracle's move was so important. That's why it caught so much of my attention. That's why I did so much research and reading on it and how I formulated my philosophy and opinion today. It was a reminder that the market has not abandoned tech. The market has just become less patient with vague stories, vague promises. If AI investment starts to pay off in a more visible way across software, cloud, chips, infrastructure, then the leadership can absolutely rotate back in that direction, even in a messy macro backdrop. In fact, that is often how leadership returns, not when the headlines are clean, but when earning strength becomes too obvious to ignore, when it just becomes too obvious to ignore. So here's my view today. Near term, I always play the long game, but I'm always looking what could set up a better long game with short-term moves. Near term, oil and Middle East headlines can keep markets jumpy, make them a little jumpy. And any escalation around Iran and the Strait of Hormuz can pressure cyclicals, complicate inflation expectations, and produce pretty violent sector swings. But underneath that volatility, the market is still looking for the same thing it has been looking for all year. Proof that AI spending is real, productive, and profitable. And Oracle just gave the market one of those clear signals yet that for at least some companies, that payoff may be arriving. So the story today is not just war risk. It's not just oil. It's not just tech. It's the fight between an external shock and an internal earnings engine. Iran and the Strait of Hormuz are telling the market to be defensive. Oracle's telling the market not to give up on the AI build out. Yeah, conflicting talking points here. And the next leg in stocks may depend on which message gets stronger from here. Higher oil and tighter financial conditions, or better earnings and clear AI monetization. That is the setup. That is the setup for the market that we're in. From an investment perspective, if you are playing the long game, I'm always talking long game. If you are playing the long game, these periods of volatility could be amazing gifts. They can be amazing gifts if acted upon. If acted upon. That's why I think playing the long game and careful, structured, disciplined diversification is how you win in the long run. And how you define win and how I define win may be different. But in the way I view it is, are we building capital in the long run? I don't want to chase some nominal, very volatile rate of return. I want to chase building capital over the long run. I think the way that you do that is playing the long game and being diversified and owning good pieces of good companies. Owning good pieces of good companies, good, strong earnings, good guidance, good outlook, good management. That's very important. I like the ones with good management and good earnings and good guidance as we look out into the future. The last thing I will say today, and I've said it time and time again, I say it in pretty much every meeting I ever have with investors. I say it in a lot of the market commentary podcasts. Do not let yourself get rattled. Do not make emotional decisions based on short-term news. The people who do that end up becoming their financial plan's biggest risk. They think, oh, the war in Iran is a big risk. For those people, the bigger risk is themselves. The bigger risk is themselves. You can't get rattled by these short-term things if you're playing the long game. If you're playing the long game, don't get rattled by these things. Stay true to the plan, adjust it, trim it, but don't make wide swath moves over some short-term news. I've heard horror story after horror story of people who've done that. If you need help working through the getting rattled practice of short-term market fluctuations, that's why a good advisor is worth every penny. They help you avoid unnecessary, avoidable mistakes. That's it for today's TD Talks. You can subscribe on YouTube, Spotify, and Apple Podcasts. I'll see y'all soon. Don't get rattled. The views and opinions voiced in this podcast are solely the views and opinions of Taylor Davis and do not reflect the views or opinions of any other entity or organization. The content provided is for informational purposes only and is not meant to be specific investment advice for any individual. Please consult with your financial advisor to address your unique circumstances. Taylor Davis does not provide legal or tax advice.